There are significant changes occurring in the U.S. housing market that may soon affect new home buyers. The main metric used to measure inventory in the residential real estate market, known as month supply, is experiencing a sharp shift. According to a recent note published by Bank of America, the housing market is expected to see a major shift in early 2024. In this video, we will delve into their predictions, why they believe home prices will start falling, the current state of home prices using interactive maps, and the potential outcomes according to Bank of America. Both home buyers and sellers should keep a close eye on these developments. After 19 months of the Federal Reserve's tightening campaign, including raising the overnight rate by over 500 basis points and quantitative tightening, which involved reducing their mortgage holdings by 15 to 20 million per month, there have been recent changes that could impact the housing market. In September 2022, the Federal Reserve ceased backstopping the mortgage market, which means they stopped buying government-backed mortgages. As a result, the market was flooded with a surplus of mortgages, which major investors have struggled to absorb. This surplus is one of the primary reasons for the recent surge in mortgage rates, which have risen from 3% to nearly 8%. The mortgage market relies heavily on the principles of supply and demand. When there aren't enough investors to purchase mortgages, lenders increase the risk premium on loans to attract investors. This process has intensified in recent months, leading to mortgage rates of 7.5% or higher. The impact of these high rates can be seen in the housing market, with home sales plummeting to record lows. The demand from buyers has evaporated, and new home sales are now at levels comparable to the worst days of the Great Financial Crisis. This situation can largely be attributed to home sellers who have yet to acknowledge what is happening in the market. Bank of America recently released a note discussing an upcoming major shift in the housing market. The note highlights the ongoing battle between inventories of homes for sale and mortgage rates, which has influenced home prices. Historically, higher mortgage rates have resulted in reduced home prices, while low inventories have increased prices. However, throughout 2022 and 2023, low inventories have prevailed, causing median home prices to remain steady despite a rise in the 30-year fixed-rate mortgage from 3% to 8%. Nevertheless, there are signs indicating a shift in this tug-of-war towards higher mortgage rates. Bank of America points out that new home prices have started to decline alongside the release of October's new home sales data. In September, new home sales amounted to 679,000, which dropped by 3.3% month-over-month and 17.6% year-over-year. The U.S. Census Bureau's data reveals that the median sale price for a new home has plummeted by 17% year-over-year. This sharp decline has occurred within just 1 year, from October 2022 to October 2023. It is important to note that these figures solely represent the sale prices of new homes, not the list prices or the median home values in neighborhoods. Websites like Zillow may still report minimal changes in estimated home values because these values reflect the overall stability in the national housing market. However, the sale price is what truly matters for sellers who are looking to close a deal. In the case of new homes, builders are finally realizing the actual value of their properties. This shift in the housing market is significant, as it suggests that sellers may need to adjust their asking prices to align with the reality of declining new home prices. While some sellers have already implemented price cuts, these reductions have been insufficient thus far. Bank of America's note indicates that further price adjustments will likely occur as the housing market experiences a reset following months of low inventories dominating prices. Bank of America notes that inventories of new homes have been increasing steadily, reaching 439,000 in October, which is close to the highest level seen in 2022. Similarly, existing homes have also experienced an increase in inventory, with a month's supply now standing at 3.6 months, the highest reading since June 2020. Its forecast suggests that if mortgage rates remain elevated and deter potential homebuyers, alongside existing fixed-rate mortgage holders opting to stay put, the inventory may exert less pressure on home prices. This creates the possibility of further price declines. However, it is important to note that existing home inventories are still relatively low, standing at 1.05 million, close to historic lows. Furthermore, home builders are cautious about overextending themselves. Nevertheless, it is unlikely that inventories of new and existing homes will decrease significantly. If this is indeed the case, it would not be surprising to witness a decline in median home prices in the upcoming months until a clearer direction in the Federal Reserve's easing cycle emerges, coupled with further decreases in mortgage rates. An interesting point to consider is that the median sale price for new homes has already experienced a significant drop of 17.6% recently. This is significant because home builders are typically the first to set market pricing. Also, Americans are becoming increasingly anxious about the possibility of losing equity in their homes, or even losing their homes altogether. Multiple statistics point to an imminent disaster, so it's important for homeowners and prospective buyers to be aware of the warning signs. Here are 15 indicators that a terrifying housing crash is looming on the horizon. 1. Unsustainable price increases. From the start of the pandemic until the end of last year, home prices in the U.S. skyrocketed at a record-breaking pace. In January 2020, the average home price was $329,000, but by December 2020, it had surged to a staggering $479,500, a 45% increase. This growth far outpaced wage increases, revealing that the housing market had entered a massive bubble. However, conditions have since deteriorated, with the Federal Reserve raising interest rates to levels not seen since the turn of the century. As a result, the average home price dropped to $441,000 in the first quarter of 2023, and further down to $429,000 in the second quarter. By the third quarter, homes were being sold for an average of $406,100, indicating a new trend of price cuts across the nation. 2. High mortgage rates. Mortgage rates have reached incredibly high levels and show no signs of coming down anytime soon. The Federal Reserve has pledged to maintain higher rates for the foreseeable future and has even hinted at the need for more rate hikes to combat inflation. Currently, the national 30-year mortgage interest rate stands at 7.87%, the highest it has been in 23 years. This means that new buyers are paying approximately $3,000 per month for their mortgages, while the average American earns just $4,600 per month. As a result, a significant portion of the mortgage payment is unaffordable for most people, which is severely impacting demand at a time when the market is already experiencing an influx of supply. 3. Sharp decline in home sales. After months of rapid acceleration, home sales are now sharply declining. When home sales plummet after consistent year-over-year growth, it serves as a warning sign of an impending housing market crash. A decrease in sales volumes can negatively impact home appreciation, and when sellers struggle to find buyers for their homes, they are forced to lower prices to attract more buyers. 4. Growing housing inventory. The supply of unsold homes in the market is increasing, with over 500,000 active listings. This rise in supply, coupled with plateauing demand, indicates an imbalance favoring sellers. 5. Shadow inventory. In addition to visible listings, there are approximately 5.5 million properties known as shadow inventory that could potentially enter the market. Foreclosures, distressed properties, and homes held by sellers waiting for better market conditions contribute to this inventory. 6. Decreased buyer confidence. Consumer sentiment surveys reveal that a high percentage of consumers believe it is a bad time to buy a home due to inflation and high mortgage rates. This lack of confidence indicates a cooling demand for homes. 7. Pessimistic real estate agents and home builders. Real estate agents and home builders are reporting decreased confidence in the market. Builders are experiencing lower levels of buyer traffic, and realtors expect a decrease in buyer traffic over the next 3 months. 8. Tightening credit conditions. Mortgage lenders are starting to restrict access to loans as losses continue to rise. Delinquency rates have increased, leading to concerns about borrowers' ability to repay their mortgages. 9. Risky mortgages. Smaller firms with lower credit standards are offering riskier mortgages, which can lead to a housing crash if buyers who cannot afford the homes are approved for these loans. 10. Mortgage insurance. Many loans now require mortgage insurance due to buyers unable to make a 20% down payment. This can result in higher debt and negative equity, especially in an overvalued market. 11. Rising foreclosures. The number of foreclosure filings has been steadily increasing. This is a sign of financial struggles at a larger scale and could indicate a potential housing market crash. 12. Negative equity. When homeowners owe more on their mortgage than their home is worth, it creates negative equity. This becomes a significant issue when homes are overvalued, as homeowners may struggle to sell their properties without substantial losses. These signs collectively suggest that the housing market is at risk of a significant shift and potential crash. It is essential for buyers, sellers, and industry professionals to monitor these indicators closely and make informed decisions in an uncertain market. Thank you for watching this video. If you found it helpful or informative, please consider liking it. If not, that's all right as well. I appreciate your viewership.